The Rebel Capitalist Show. What are your views on the UK, most specifically them going right back to quantitative easing? So for those who aren't following the story, last week, Liz Truss came out with her mini budget, which I did a whiteboard video on it. It was okay. I mean, I always like tax cuts, but the tax cuts were more for the financial economy, but that she combined that with additional government spending to prop up the economy from going into a recession at a time when they've got 9% plus consumer price inflation. I mean, that's just absolute madness. So basically what happens is the long end of their curve blows up, which started to blow up the pension funds because they had those bonds, but they were levered up because the interest rate they're getting on those bonds was so low. And to meet their obligations, they needed 6 or 7% return. So, you know, the central bank, the BOE, gets a call from the pension fund and says, hey, you got to do something about this. You know, we're about to blow up. We're about to go bust. And then all these pensioners are going to be out and then most likely going up to the streets with the torches and pitchforks. So then they had done quantitative tightening officially for 1 week. Brien, 1 week. And then they had to come out and say, whoops, sorry, we're going to go ahead and do quantitative easing once again. So what are your thoughts on what happened in the UK? And do you think we could see something similar happen here in the United States?
Oh, absolutely. I think we're going to see something similar. You know, I put out a tweet that, you know, it was amazing what happened in the UK. They go to QE temporarily, of course, they assured us.
Yeah, right.
And then the US stock market just took off. Everything took off because this was a hint that another central bank was possibly considering going back to QE, which might hopefully at some point in the future influence the Fed to also take its foot off the gas. And all of these very minor influences and implications, a big chain of logic that all had to happen. And that led the stock market to take off in hopes that there was a pivot coming. So I put out there that what's going to happen when there really is a pivot if we see this kind of a reaction to it. And then I got a lot of replies to that tweet, like it was not quantitative easing. This is not going to be permanent. It was just that the UK pension system was within moments of completely blowing up.
That's what Ben Bernanke said, Brien. Brien, that's what Ben Bernanke said.
Yeah.
You know, and Schiff always makes that point very well. He said when they first started QE, they didn't call it QE1 because there was only supposed to be one. They only called it QE1 when we went to 2, 3, 4, not QE, then QE infinity. I mean, it's just, whoever buys that nonsense when they say, that's another thing that I find hard to believe, especially since what we've dealt with the central planners and the authoritarians since 2020. The fact that anyone believes what they say and takes them at their word is just, it blows me away how naive it is.
Yeah, you just need to look at it and figure out what the precise opposite of what they're saying would be logically, and that's exactly what's going to happen. But it was so funny to me that people were assuring us that it's not a big deal. It's just that the pension system in the UK was within moments of collapsing. That's all it was.
Yeah, which, by the way, probably was the reason why Credit Suisse's credit default swaps skyrocket. I don't know if they had any exposure, but that whole financial system has so much systemic risk. I don't know how the pension funds blowing up wouldn't also somehow impact Deutsche and Credit Suisse.
And maybe it didn't, but the underlying issue, the underlying storm, rising rates are creating all these different stresses. You know, hurricanes spin off tornadoes, often in advance of the actual storm. So you have these little blowups that are the sign that something's going to happen and something's on the way. I mean, we saw that we saw the stresses in the housing market before the great financial crisis. You can see the Bernanke quotes and the like in early 2008. And everything's fine, you know.
Contained,
it's not. The first signs were already becoming evident.
You know what else? Another thing that surprises me, and I've always thought about this, the politicians and kind of the central planners that are very alarmist, let's say, about climate change. And I'm not here to say it's real, fake, you know, anything that's for another conversation. But those types of people always educate us on how intricate the ecosystem is. But ironically, those same people want to or ignore the fact that the economy, especially the global economy and the global monetary system, is just as intricate as an ecosystem or the environment. So it's bizarre to me that they get it on one side, but then they totally ignore it on the other side and want to come up with all these policies to interfere with a complex system that's just as complex as this environment that they're worried about.
I think it's intellectual hubris. They think that they can understand. They think that science, which is always evolving, it's never settled. But they think that science has settled this question of global warming, of climate change, and we know who's involved, we know what we have to do, and we know it to 2 or 3 decimal points. And of course, we don't. You know, it's far too complicated. But they think that because they can understand that and science can understand that, then the experts, the professionals that we all need to trust, also can understand the economy.
Right.
And you know, back to Adam Smith and everyone afterwards, and you can't. All these individual actors pursuing their own self-interest will inevitably find the most efficient allocation of resources. And it's impossible for any one person to know. So they think they think that somebody with enough letters behind their name will be able to come through and figure everything out.
Right. And that basically are the central banks and the politicians. So, I mean, that said, it goes back to what we saw in the UK, where the United States market saw that and said, aha, we're going to go ahead and now it's risk on, because we think that increases the probability substantially. We get a pivot from the Fed in the near term, just like the Bank of England. You mentioned the stock market, but I also saw gold scream higher as well. So I know you've been paying attention to the gold market, the silver market. So what's going on there? Do you think this potential pivot in the United States or maybe with other central bankers is going to be bullish for that? And then I also want to talk about maybe why gold hasn't performed that well in dollars, but I also want to point out that gold has performed extremely well in other currencies. So, because I get that online every once in a while, they say, oh, well, gold isn't a store of value anymore because it hasn't gone up in lockstep, you know, week from week with the CPI and in the United States. I'm like, you know, that's not the way it works. But anyway.
Yeah, you know, we have to realize that we're at the tail end, the end game of a 40+ year, perhaps even 60-year trend of ever easier money, where the central bank has responded to every little hiccup in the economy with easier money, and the markets, as a result, have become addicted to that. And especially post 2008, where we got zero bound on interest rates, and they had to come up with all these new programs and acronyms and QE itself. So the markets have become addicted not to easy money, but ever easier money. And we have to recognize too that because of that, everything has been floated higher on this sea of liquidity, and all of the correlations have trended toward one. You know, we used to have balanced portfolio. You would be in bonds and stocks because when one went up, the other went down, and it would be balanced and risk adjusted, et cetera. Now everything's going up on the sea of central bank liquidity, and the traders in New York are setting the prices every day for every asset class. And in their view, anything that indicates a restricting of that flow of central bank liquidity means sell everything. Anything that indicates or implies a resumption of that liquidity means buy everything. So now everything gets bought and sold together, depending on what the current view du jour is of future central bank policy, the Fed policy. And that's why gold has been actually trading with the stock market. And if we do have a pivot, or at least even a pause in the Fed policies, then everything is going to go up like we saw as we speak over the last couple of days, where everything soars and goes up together. I'm not a big believer that we need to have a stock market crash to have gold go up. I think we will, when the Fed comes back to kick the can again, I think everything's going to go up and gold will go up as well. There is one potential scenario coming up, though, and I think fairly soon, and that's that the Fed, well, the cost of servicing the debt with the Fed's interest rates are absolutely soaring. The latest update had it at 648 billion, which is a new record by a considerable margin per year at an annual rate. When we get the next report on the GDP, third quarter GDP, buried in that is going to be the interest expense. And I think that number is going to shock people. It's going to be heading toward $1 trillion a year. So I think the Fed, if for no other reason, if not for breaking the economy, the global economy, which it has the risk of doing at any moment, just the cost of servicing the debt is going to stop the Fed. So if the Fed has to stop its interest rate hikes while inflation remains elevated, that's going to essentially be an admission that they're powerless to do anything about inflation, given the size of the debt. That kind of an environment, unlike the previous ones, is not bullish for stocks, it's not bullish for bonds, but it is bullish for precious metals or tangible assets for real things, because we will be in an environment where we have high inflation and the Fed just can't do anything about it. So that high inflation is going to eat away the value of bonds, of equities, et cetera, et cetera. If just a little bit of that money that's out there in those other asset classes gets reallocated toward gold, you know, it's going to be like our friend Doug Casey said many years ago, trying to fit the contents of Hoover Dam through a garden hose. You know, you can't do it. So it would be an explosive reaction. Now, that might be my gold bug biases tainting my analysis, but that's a potential scenario that we could see, you know, happen over the next few months.